Hello there, everyone, and welcome to our latest episode of the Market Misbehavior podcast. I'm Dave Keller, founder of Market Misbehavior, and it's been such a pleasure to bring you this podcast here as we near our 40th episode since launching last fall. It's been so fun to sit down with market practitioners, traders, authors, educators, brokers, money managers, strategists, anyone we can talk to about the market conditions. Great to sort of unpack their thinking, their approach to the current market environment, how they're navigating the market in very uncertain and unstable times, their best ideas and where they're finding potential opportunities, and just how they are keeping a proper perspective within a period of market dislocation. Today's episode is with one of my favorite guests over the years, Mish Schneider of MarketGauge. I met Mish years ago at a money show event down in Las Vegas. We had an interview, and immediately, the moment we started talking, I remember thinking, boy, she's just a fantastic market strategist, trader, great experience, able to articulate a lot of different things, but a simplistic way of breaking down what often can feel like very complex topics. So in today's conversation that I'll share with you, we talked about tariffs and we talked about other macroeconomic influences. We actually recorded this discussion on Tuesday, April 1st, just before Tariff Day on Wednesday, April 2nd. A lot of uncertainty about what to expect, and I think no better time to sit down with Mish and just understand how someone like her, who has navigated so many different market environments, different market cycles, how she deals with new environment, new expectations, but a lot of similarities, right, between previous market cycles. So we talked about different macro themes, and I think one of my favorite takeaways is to focus on the charts, to focus on moving averages, focus on behavior of markets as a way of understanding the behavior of investors. Along the lines, we really dug into what she calls her economic modern family. These are a set of ETFs that she feels really define the market environment. They're the most important charts to watch. In particular, we talked about semiconductors, their dominance in 2024, transitioning into their underperformance in 2025. We talked about what she calls granny retail, the XRT, the retail ETF, why that's such an important gauge of consumer sentiment, but also its lack of upside performance so far in 2025. Talked about transports and why transportation stocks are so important. Really goes back to Dow theory, in my opinion. It was one of the original ways that transportation stocks were measured, but still to this day, an important way of measuring the expectations about economic growth going forward. As usual, I try to ask every guest about small caps, but small caps are one of the important ETFs that Mish tries to follow. So we looked at the IWM, talked about the small cap ETF and what that might mean. What was so important is we talked about commodities, particularly gold, and she pointed out silver. I asked her about gold, and I think very noticeably, we talked briefly about gold, but she really focused on silver as a more important chart to watch right about now. Talked about the gold to silver ratio, which I thought was a really interesting way of relating where we're at right now to some of the longer term history in those commodity series. Finally, one of the most interesting charts we looked at was a monthly chart with the 23-month moving average. We have a couple examples we'll show you in the course of our conversation, but I thought it was fascinating at a time when so many of us are hanging on every little move in the markets, every day, the open to the close, hourly fluctuations, because every move seems to have meaning. Here's Mish Schneider looking at long-term monthly charts for multiple years, looking at the 23-month moving average. Great reminder of one of the things I always tell people: when in doubt, zoom out. So a wonderful time to sit down with someone who I've really come to trust and whose point of view I always appreciate. Please enjoy this conversation with Mish Schneider of MarketGauge. Super excited to be sitting down today with Mish Schneider of MarketGauge. Mish, I mentioned before we hit the recording, you are my first repeat guest on the new Market Misbehavior podcast. So thank you so much for coming back. Good to see you.
Oh God, Dave, that's such a wonderful thing to hear. I'm so honored to be your repeat guest, and we have some history, so it's wonderful to see you again.
No, and listen, we were talking. We met years ago at the Money Show, and it's turned into a great sort of professional relationship. Interviewing you a number of times, when I think back of these last number of years and navigating these markets, conversations with you have certainly been a real pleasure and a highlight. So I appreciate you being willing to come on in a arguably probably the most tumultuous time I think you and I have talked. Maybe, I don't know. But it's a challenging period right about now.
Absolutely. And one of the things that I sort of thought about over the weekend was that the other corrections we've had since, say, 2000, we can obviously go back to 1987 and others, but we just start at this century. From 2000, of course, it was sort of a single focus correction. Clearly, the dot-com bubble started it. There were some other things that happened, like 9/11, and then the malfeasance of Enron and some of the other greedy CEOs, but it was still very much about one topic, right? And then in 2008, it was really about one topic. It was the mortgage debacle and Lehman Brothers. And then in 2011, it was a flash crash, but it was about the government shutdown. And then, of course, in 2020, it was COVID. So now here we are, and 2022 was really more about interest rates, if we want to include that as a good correction. But now we can take a multitude of reasons for why we're here. It's not a one issue thing. It's a complete upset of the status quo for a huge gamble, which may or may not pay off. And then there's collateral damage along the way. And it's everywhere, from geopolitics to the tariffs to a stagflation environment, which we haven't seen, to a Fed a bit less cooperative with the Trump administrations and being somewhat stubborn about where they're going to go with rates. We've got Iran still out there and Russia still out there. And now we have today, the JOLTS report came out. We see employment numbers probably going to go up. Prices still going up. It's pick your poison.
Yeah, I was going to say, every one of those bullet points, I feel like we could go through in detail. I feel like there's so many things we could kind of review here. Talk a little bit. We're obviously doing this in tariff week, I guess we'll call this, right? We've got the reality of tariffs maybe coming up here very soon. We're in uncharted territory, pun intended. I feel like, right? This is sort of new territory for a lot of investors. What could happen and how things are playing out. It feels like the market was sort of pricing in a lot of optimism, but more recently, obviously not, right? Investors are a lot more anxious about what could happen. How do you sort of set the odds on outcomes in this sort of environment where, again, we've not really seen this sort of aggressive tariff change. We've not seen these sort of policy changes. How does that inform your decision making today when you're trying to position yourself?
Well, one thing that you and I have in common, or we have many things in common, but it's technical analysis. And I know that it's been sort of a mixed bag for traders and investors to even consider the charts and what's going on in the world of technical analysis, because it's been relatively easy for the last couple of years.
Yeah.
But this is really where I think the background that you and I have come in handy. And so for me personally, I focus on my economic modern family, which has given me so much information. And then, I look at a sort of a multiple time frame. So there's the daily, the weekly, and the monthly, and that's given me some kind of a perspective. And so if you just really understand things like phases, moving averages breaking down, volume patterns, some of the market breadth, which I know is your thing that you really talk about a lot, the risk factors, what the bonds are doing versus the SPY, the gold market. If you start looking at all these charts, it really tells you that what I think a lot of people did, I don't know if I want to use the word wrong, but what they basically overlooked was the face value of what the Trump administration was telling you. Besant, Lutnick, they're all telling you there's going to be pain. We don't care so much about the stock market. We think the economy right now, we're willing to put some pins into the pin cushion, because we think that the outcome is going to be different once we get everybody to play nice with us. People seem to think that, they don't really mean that. He's going to roll back tariffs, this, that. And I think what they're finding out now, and you could see it in the charts, but the price always dictates the narrative. There you go. The narrative and what the price has already been telling us.
It's so true, right? And I feel like there's been this sort of a disbelief phase, I guess, in a lot of ways, right? As much as the markets initially have had a pretty sudden drop. I'm going to bring up a chart of the S&P here in a minute. When we think about the fact that the market has come down a bit, there still seems to be a lot of, I guess, optimism underneath the hood, I guess I would say. People sort of expecting a bounce. Do you see the sort of environment we've sort of gone from S&P 6150 to 5500? Now we're kind of chopping around between 5500, 5800. Is this a buy the dips kind of environment or a sell the rips kind of environment? And how do you differentiate between the two?
Well, of course, how you trade makes a difference. If you're a day
Hmm.
trader, it's been mostly working to sell the rips and buy the dips, but we're
Yeah.
talking about very active type investing. Those people have been the winners this year who do that. For those of us who are more position traders and advise people and actually have an asset management company where it's all about position trading, it has definitely been a more challenging environment to come out and say buy the dip. So what
Yeah.
I've done this year is I've made a complete shift in that we saw, and you're looking at the chart. First of all, it's still under the 200-day moving average, and Paul Tudor Jones is famous for saying anything that happens under the 200-day moving average is not good. So that's what institutions watch. Of course, there's been a tremendous amount of institutional selling going on since the beginning of the year.
Yeah.
So if you really want to start buying the dips, you have to have a good reason. This has been my pet peeve when I've listened to a lot of mainstream media have people on that keep talking about this is a generational buy opportunity, this is a buy the dip, just close your eyes. Because I wonder who they're talking to. People who can afford to sit through now 30%, and if you're looking at something like NVIDIA from
Yeah.
the top, to a 50%, to a 60%, to a 70% drawdown. That's where we get back to the chart. So if you're looking at this chart, yeah, you found some interim support and we're getting a pop, but it has to be a little bit more sustaining than this. And the S&P is still doing better. That's why I think we should go to we just have to look at two components of the economic modern family, and it's going to tell you pretty much everything about this buy the dip thing.
Yeah. Let's do it.
Well, let's go to XRT, Granny Retail. I know that I have, good old Granny has been the most reliable sector. And if you look at right in the beginning of the year, it made the one little teeny rally after breaking out of a massive consolidation, which is what I think you and I talked about when we saw each other in last October.
Yeah.
It didn't really go anywhere. We got out almost immediately. And then look how Granny was the first one to start to fail the 50-day moving average, even before it got below the 200. And look at the slope of the 50 was starting to point down. So already I was starting to say, if you have the consumer losing faith in the economy and this administration, that's trouble. So there was not going to be my buy the dip moment in that type of situation unless we broke down and came right back. But that's not what happened. We just continued to break down and the rallies got shallower and shallower and shallower. Now you can see that we got to some level of support, right? Look at how nice it is from that. If you go to the left, from the last low that we had, looks like that was in the beginning of, what is that, 2024?
Yeah, 2024, right.
Right. So, we could say potential double bottom, and there's certainly been a lot of volume, but we don't have the evidence of that yet. So now maybe for the first time, particularly in my vanity trade, I'm starting to buy some dips, and we'll get back to my point about buying the dip versus the breakout on consolidation. But Granny rules. Granny ruled us on the way down. Granny will rule us also on the way up, because if the consumer comes back, that means basically forward thinking. They think tariffs are not going to be as bad. Inflation is going to be more transitory. The economy will do better. They'll have more money in their pocket. Maybe there'll be tax cuts, optimistic. This to me is really maybe the first time we can be tinsy optimistic, but I think with all the factors we just talked about, you have to be patient.
It's really interesting, Mish. I love that we're focusing a bit on the chart. There are a number of things to talk about here, but particularly when you think about the consumer, I mean, the argument here, and I think the reason why this is part of the economic modern family is because retail stocks are a great read on consumer sentiment and consumer behavior and expectations of how that's going to change. It seems like recently consumer sentiment data, taking more of economic data, has been weaker than expected. Some of the inflationary readings coming in a little stronger than expected. So I think some people are thinking retail is obviously a really bad place to be, which it has been for a while. But is it fair to say that you'd probably see a recover in like the XRT first before you'd see some of that economic data really start to improve? Is that fair to say?
That is fair to say. And
Yeah.
what makes the economic modern family so interesting is that it often is the first one of the members, and you never know who it is, which is why you have to watch them all. But one of the members will either be the first to tell you there's trouble in paradise, which is what the consumer sector did. And often it's the first to tell you you've got the all clear. So like if we go back to 2023, for example, when things were starting to look good, we had the regional banks, which is in my family, KRE, with the banking flash crash, warn us it was time to not get so long. Now, since we had the warning from Granny at the top, and we really did, I kept scratching my head going, I can't be so bullish. That could be a signal. And the other chart we have to look at, and I think the most interesting chart, part of the family, is tech. Since everybody loves tech, I'm trying not to buy the dip in tech because I'm not sure it's over. That's why I'm focusing more on maybe the things that we can actually create in the US. But if you want to put up a chart, can you put up SMH monthly chart with a 23-month moving average?
Whoa. Okay. Tall order. We're doing it. All right. So we've got the
All right.
monthly SMH, and you said
And just
23-month.
Yeah, 23-month moving average.
I got you.
This is going to blow your mind. I mean,
Okay.
because
Here we
really,
go.
everything you need to know. Can you kind of zoom out a little bit?
Bring in more data, you mean?
No, less data, so I can see the more recent activity.
There we go.
Okay.
So this is the last 10 years.
Right. This is going to blow your mind. So we just saw Granny as possible bottoming formation, possible. But if you looked at that monthly chart, which we don't have to, I could just tell you, Granny's under the 23-month moving average right now. So even if we stay above 70 in XRT, we still have to get back over 71, 50, 72. And of course, we have to stay there by the end of April because it's a monthly chart.
Yep.
This chart, so SMH, the semiconductors, have been above this moving average, this 23 moving average, for a very long time now. And it's sitting right on it right now as we're entering April. So I think the writing's on the wall. If I had my best tip, without all the politics and without all the tariff talk and all the fear and recession, stagflation, just from a technical standpoint, you got to watch XRT, because if the consumer comes back, good sign, and I would want to see her get back over 23-month. Oh, by the way, why 23-month? Because it's a 2-year business cycle within a longer business cycle of the 80-month, which you don't have to put in. Obviously, semiconductors are well above. That would be 6 to 8 year. In this 2-year cycle, we've seen contraction, we've seen expansion, we've seen mainly expansion in SMH. One short period of contraction that we saw there a couple of years ago, that was during the whole rate hike thing. But since then, nothing but expansion. So if we're going to go into contraction here, and Granny can't hold up, well, there's 3 scenarios. Granny holds up, clears back over the 23-month, semiconductors sort of sits here and doesn't do anything. That's still a good sign. Number 2, semiconductors start to break down under this 23-month and basically drags down the entire market, in which case the consumer would get spooked again. Or scenario number 3 is this not only holds, even if Granny kind of sits where it is right now and starts to go up from these levels, proving that this was just a correction to that business cycle, 2-year cycle, that would also be a good sign. So that, I think those 2 things are really all you need to watch with some patience if you're positioning.
I love what you're saying, Mish, is basically at a time when everyone's so focused on like the moment to moment changes in some of these daily, I mean, the daily reversals just in the last couple of days have been dramatic, lower opens, higher closes kind of things. The monthly chart and just recognizing the bigger picture trends are so important. You mentioned, and when I have you on, Mish, I love to just talk a little bit about the economic modern family, because when you and I first met, you shared this idea that you had about tracking these major ETFs that track major components of the economy, and it made so much sense. Can you give us the quick rundown as to what the economic modern family is, what kind of general components you have, and why they're so important to follow in your work?
Well, it basically tells you, and it's a US centric, by the way, so I always have to preface that, and it's not commodities related. That's a whole other conversation we can have, because I've been a commodities trader for most of my life. But essentially what it did was it gave me an idea. When tech was running, I could still gauge, because I had semiconductors, sister semiconductors in the family, to tell me that. But I really knew that in terms of what we were hearing about great growth was probably an over-exaggeration from reality. Why? Because grandpa is the Russell 2000. And we know that if you look at the ratio between the SPY and the Russells, it's been so wide with them so underperforming. If Trump's policies are going to work, it should be good for grandpas, like I like to call them, or IWM, because it means those 1,000 companies, mostly with a presence manufacturing in the US, are getting money, whether it's incentive money or whether it's the tariffs. Don't worry them, because they are not necessarily going to be hit with tariffs because they're being encouraged, like in Intel, for example. This is the number one. Number two, of course, is Granny. We talked about that. Number three is transportation, because you cannot talk about an economy improving if you're not seeing goods and services move, freights, trains, and automobiles, sort of thing. And that's also been kind of lagging, but also sitting right at critical support right here. And then regional banks we talked about. And then the last one would be biotechnology, which is such an interesting sector because it can do well in a cyclical or in a non-cyclical environment, but it's been a big political football lately with, again, the admin change and, are we going to take off commercials for drug companies? Are we going to restrict them? Are we going to tariff and not allow any drugs from other companies come into the US? That's it. But you don't have to worry about all that. Just watch IBB. It's completely broken down. So you want to keep an eye on that too. And then I think if you look at all of that, you can say, oh, manufacturing's contraction, consumer is hurting, transportation is slowing down. There's your stagnation part. Semiconductors have corrected. Their peak is in. They don't have to go up from here. We just don't want them to crash. Everything's cyclical. We have to look at the regional banks. They've actually done relatively well, but not great. So you want to look for that to see if there's going to be any kind of commercial loan debacle again. And you can make a story from all of those characters. And that's why I put that together, because it allows me to go on the news and sound really smart. But all I'm doing
For the record, I don't think you need those to sound smart on the news, Mish, but I appreciate you saying it.
Well, it gives me a story, and everybody likes a story, and there's your story right there.
So let's dig into a couple of those if we could real quick. Transports, often comes up because I know it's one of those things you look at. The IYT is one of the transportation ETFs. I know I keep track of. I mean, that's an area of the market that's obviously been struggling. And if you look at transports relative to a lot of other groups, it's been one of the laggards, has underperformed for quite some time. I mean, how important is that for transports to start to improve? And what would that tell you if you finally do get that improvement in the IYT? And what gives you the confidence? You mentioned maybe near support. Is this an opportunity in an area that's been beaten down quite a bit recently?
I don't know if I would go that far yet.
Yeah.
We do have another, again, we can create a story around the chart, but this lack of tourism, or this sort of global movement that we've got right now, don't go to the United States. Tourism is 9% of the gross domestic product, right? We need people to come here. And so that's what you're seeing reflected in the charts. And that's why I love the price dictates the narrative thing. So you can see this is broken down under everything. And even though we've got maybe some historical support, if you go back just a couple of years around these levels, let's look at that monthly chart again. Do you still have my 23-month chart up there?
For sure.
So put in IYT.
Yep.
It's broken down under it.
Yeah.
So right now, what best we can say is this is looking like stagflation, maybe a speed bump to recession. This is looking more recessionary. And what would save that, because we're going into a 2-year business cycle contraction, and what would save that would be if Granny can pull herself up, maybe if semiconductors can pull itself up. But transportation in 2004 was the first to bottom after all that mess that we went through from 2000 until 2004, because all of a sudden things were starting to move again. So that's why you say you never know who's going to lead and who's going to lag. But right now, transportation is, I don't think, a leader or a laggard. I think it's just reacting to policies and the uncertainty of those policies.
That's a great point. One final, we're out of time, Mish. I wish we had hours to talk as always, but one other area of the market that's actually, let's focus on an area of the market that actually has been demonstrating quite a bit of strength in the commodity space, precious metals, gold, silver, all breaking out. Gold now well above $3,000 an ounce. That felt like a level we may never get to, and now we've blown through it. Is that an area where you see continued strength? I mean, certainly at times has not been a great safe haven in an inflationary period, but now seems to be a great place to be so far in 2025. Do you have confidence that that sort of trend continues? What sort of charts would be looking at to navigate gold, precious metals here?
Well, I really wanted today's takeaways to be what to look at, and we talked about the retail and the semiconductors and where they are in an economic cycle and transportation. That's the stagnation. Do we go to recession, or we get out of the stagnation of the economy question? But that to look at. In terms of, are we going to go to the inflation part of stagflation? Gold has been rallying mostly as a flight to safety. What do we have to look at to see if gold's going to continue for a more inflationary? And that's where silver comes in. And right now, silver to gold ratio has still been really in favor of gold. It's at about 90 to 1, which is pretty high. So that means gold's trading 90 times the price of silver. In 1980, it was 17 times the price. So I think rather than watch gold so much, I think you really have to watch the silver. And it's been $34 has been holding. If it gets to 35 with any gumption and it starts to outperform, that's our trifecta number one. Number two, of course, would be the dollar. Also still hanging pretty tough. People calling for the collapse of the dollar. All it did was go to massive support at 103. If you're looking at DXY, now it's back over 104. Not really showing too much inflation right here. Could be dangerous if it does. And of course, number three would be the agriculturals, particularly the softs. I like to look at sugar, has always been my barometer. Everybody thinks that's fascinating. But the truth is, it's a world staple and people hoard it. And if it starts to get over 20 cents a pound, it's trading right now at around 19 cents. That also is an indication. So I'm all about the indicators. We got the granny indicator, we got the tech indicator, we got the rest of the family to look at, and then on top of that, now you really got to watch that. So to answer your question about what I think gold could go up at this point, I really think it's going to depend on silver to see what happens.
Every time we speak, Mish, you remind me of that, and I already jotted down silver to gold ratio. So as usual, you've given me some things, and I think others some things to think about, and I appreciate that as always. Mish, such a pleasure to catch up with you. I really appreciate it. Where can we point people to learn more about you, what your team is doing at MarketGauge?
Well, we do have a website, MarketGauge.com, and Jeff does webinars pretty much every week, and he's really great. I write a daily blog that you can see on Substack now, or on Twitter, or on our website. And then every week, Keith and Jeff do an outlook, which covers those risk factors that we didn't get to talk about today. But it's really a great newsletter to follow in terms of what's happening with the sentiment overall. So, we give a lot of stuff away for free. Obviously, we also have a lot of tools. We have models and things like that. And if you want to just talk to me, best place to talk to me is at Twitter, which you see right there at Market Minute, X. And I'm very, very, very happy to answer questions and have conversation on there.
I appreciate it, Mish. We'll put links to all of those in the notes for today's show. But listen, thanks so much. I appreciate it. Have a fantastic spring. Hang in there, and we'll look forward to catching up with you again real soon.
Thank you so much. I'm, again, so honored to be your repeat guest.
It was a lot of fun. It's so good to catch up with Mish, and I've interviewed her over the years in my Stock Charts TV days, and now with the new podcast. She is my first repeat guest on the Market Misbehavior podcast. We first sat down with her last fall, and it was great to circle back on some of the same topics we talked about, but also kind of navigating a very different environment from Q4 of 2024 to now Q2 of 2025. I love that monthly chart with the 23-month moving average. That's one I'm going to keep an eye on, because I thought that was a really interesting way of differentiating which ETFs, which sectors, which themes were holding up, and which ones were starting to struggle. Really appreciated her comments on the commodity space. We talked a little bit about it, I think, in our conversation, but Mish got her start trading agriculture, right? Trading commodities. So I always find it's interesting. We've often talked about things like the DBA, the agriculture ETF. Today we talked about hard metals, hard assets, silver, gold, the silver to gold ratio, and I thought those charts were really, really interesting to sort of talk through with Mish. She mentioned her new newsletter. We'll put a link to her newsletter and also their website in the show notes, so make sure you check out Mish and her expertise. Again, fantastic experience in the markets, and so cool to get her take in a challenging, uncertain market environment here in April of 2025. That's it for today's episode. And by the way, if you want to learn more about some of the technical analysis tools that we approached, how we actually zoom out, what that means to bring in more data, to bring in different technical indicators and think about multiple timeframes in a consistent, disciplined way, our Market Misbehavior Premium members may be a great way for you to upgrade your own decision making and your own analytical process as we continue on through 2025. 3 great benefits of the Market Misbehavior Premium membership. First, access to all of our virtual courses. Flight School Behavioral Investing is where you'll start. That's where we talk about behavioral biases, what happens between your ears, in your head as an investor, and also technical analysis, which I see as a practical toolkit to understand the world around us. You will also have access to all of our members-only reports, like our weekly flight plan that we put out every weekend, and also our monthly chart review. We actually just did the April monthly chart review earlier today, where we apply our proprietary market trend model to a series of ETFs and asset classes. Finally, you'll have access to our members-only community where you can ask questions. You can learn from others' questions. I'm in there every morning answering questions from our premium members, sort of an ongoing dialogue with some like-minded investors navigating these markets, sharing questions, sharing perspectives, sharing ideas, and it's a great group with which to navigate these markets in uncertain times. For more information on the premium memberships, go to marketmisbehavior.com/premium. Don't forget to use the code PODCAST for 30% off your first 12 months on any plan. That's it for today's episode. For Market Misbehavior, I'm Dave Keller. Have a fantastic evening, and remember, it's always a good time to own good charts.